There is a lot of noise coming from Wall Street right now that people are mistaking for proof that XRP is about to go live. Grok says that BlackRock and Fidelity are filing XRP ETFs on the spot, and CoinShares suddenly pulls their XRP ETF filing. The crypto space is buzzing like a huge bomb is about to go off. But let me tell you the truth. Most people don't actually know what's fact, what's opinion, and what's flat out wrong. So today, I'm going to break it all down with absolute clarity. What is really going on? What is being said? What is certain? What's true? What is just crypto telephone? Right now, I'm going to tell you everything you need to know. Let's start right away. Hey everyone, nice to see you again. Don't forget to like and subscribe to stay up to date. This was not a mistake made by a clerk. This was not a change to a form. This wasn't a short-term departure for strategic reasons before filing again under fast-track rules. Their November 28th SEC filing, which is marked RW, makes it very clear that they are pulling out of the USXR PTF race totally. Another thing is that the file is not written in a way that makes sense. We're done with this offering in the US. For now, it says, thanks and goodbye. So why is that? It's not because XRP is dead. It's not because sales are going down. It's not because CoinShares changed their minds about digital assets all of a sudden. It's because huge companies are completely destroying the US ETF market. We're talking BlackRock, Fidelity, Bitwise, Franklin Templeton, monster companies with a lot of name trust, a lot of distribution power, and very small profit margins. It costs a lot, is hard, and has an unfair risk-reward ratio if you don't already have billions of dollars coming in. They are not trying to fight a war against companies 50 times their size. Instead, they are focused on their NASDAQ merger, their European products, and their overall strategy. That part is true. 100% can be checked. That's what's really going on. And this is where the guesswork comes in. Is CoinShares pulling out because BlackRock and Fidelity are planning to file spot XRP ETFs behind the scenes? That's when Grok and others stepped in and said that's why CoinShares pulled out. On the other hand, neither BlackRock nor Fidelity has officially filed until we see their full S1 registration forms, always. For now, just believe the story, not anything else. To really understand how big the CoinShares choice is, you need some background. Depending on which part of their report you look at, CoinShares is in charge of between $7 billion and $10 billion in digital assets. The value of their most important real Bitcoin ETP in Europe is about $8.9 billion. When it first came out in Europe in 2021, their physical XRP ETP held about $245 million. The person in question is not a small one. They really are a big asset manager. But once more, Europe is where they live. When BlackRock and Fidelity show up with laser swords, the US ETF market is like a gladiator ring. Everyone else comes in with pool noodles. That's why CoinShares left. It's strategic, not pessimistic. Things get even more interesting now. Some people are taking steps back, but the market as a whole is taking steps forward. Chad said earlier today that filings for spot XRP ETFs are going through the roof and aren't slowing down. The law is becoming clearer. Demand from institutions is going up, market infrastructure is getting better, and XRP is still one of the few large cap assets that has a lot of buyers and sellers, users around the world, and now a clear U.S. court decision that separates programmatic sales from securities violations. Franklin Templeton said that more than 6.7 million shares were bought and sold. Bitwise is at 546 million, and Canary Capital is at 599 million. The big surprise is that the 21 shares US XRP ETF should go live early next week. If you know how ETF systems work, you know that this is not a bad sign. We call this early firing. People who know what's coming are paying attention while everyone else is looking for Black Friday deals. The world's financial system is like a plumbing system: settlement, payments, messages, and compliance rails. And XRP is one of the few assets that is already built into that new system. A lot of people still don't know what DLT settlement tracks are. It's the organizations that do. They are the ones getting ready to move trillions. They don't do these moves just for fun either. They have to do them because the pipes are moving. Let's talk about the supply side of XRP now, since this is where everyone is going crazy. There are about 4.2 billion XRP in exchange accounts, but that number doesn't tell the whole story. Some of that XRP has already been bought. Some of it is company money. There is some private liquidity. Some of it is in trade wallets that are shared, which makes it hard to tell who owns what. What matters is that over-the-counter OTC stock is dropping quickly. You saw the net flow of money. Not long ago, 25 million XRP left platforms. That isn't very big by itself, but it points the way. And when ETF makers buy, they don't want to crash the price or move markets, so they use OTC desks. However, OTC desks don't suddenly make more XRP. When they run out, they have to get more, which is usually done on the secondary market. Here's the important law part that most people get wrong. Now, Ripple can't sell XRP straight to US banks. In 2023, the court said that those straight sales to institutions were not registered securities offerings. It's true that the SEC dropped its appeal. In order to raise money, Ripple did get a tight waiver, but that doesn't mean that companies can again buy XRP from Ripple in large amounts. So people who want to make ETFs can't just walk up to Ripple and say, hey, we'd like 100 million XRP. They need to get things from the market. That's why the changes in supply are important. And no, Ripple Prime does not magically bypass the ruling. The legal meaning doesn't change whether Ripple gets XRP from escrow or the company's treasury. It only matters that the front-end execution takes place on a brokerage platform. Ripple can't use backdoor routes to do the same thing under a different name because of the judge's order. Which brings us to the main point. Buyers of ETFs have to go to open markets to buy more cheap OTC product when it runs out. When multi-million-dollar blocks hit markets that don't have a lot of sellers, the price has to go up. And this is where the whole picture gets even more interesting. It's easy to see why analysts have been screaming that XRP won't really move until institutional buyers are forced to buy it on the open market. This is because of legal restrictions, the demand from ETFs, the shrinking over-the-counter supply, and the way the secondary market works. Because that's when price is based on how little cash there is instead of how people feel. Right now, we're slowly moving toward that moment. The big question being asked is whether Ripple can sell through non-US companies or whether institutions can buy through foreign subsidiaries to get around the limits in the US. It's a good question. Since banks work all over the world, they have branches all over the world, but the market can't think Ripple is breaking the rules until it knows how certain deals are structured. It's clear what the judge wants. In the US, Ripple can't use the same method of direct sales to institutions that the court said were not registered stock offerings. It doesn't make that limit go away just because the sale goes through Ripple Prime or a different business unit. What counts is the economic substance, not the package. That doesn't stop people from guessing, though. Some people wonder if Ripple could properly sell XRP from their European branch to an Asian branch of a US institution and then get the XRP from the Asian branch. In theory, it's possible. Legally tricky structure is something that global companies do all the time. But since the decision, Ripple has been very careful because they know the SEC is still watching, even if it were legal. They just got over a long court battle. They're not going to make things worse by doing something that looks like they're trying to get around the court order. That's why the ETF part is so important. Ripple can't be relied on by ETFs. They must rely on the market, long-term buyers, exchanges, and over-the-counter OTC pools. That's it. And that's how the system is meant to work. A spot ETF should get its goods from the open market, not from the assets provider. This next step is very interesting because of that. A lot of people still don't get how ETFs pull in money. They believe that ETFs only buy XRP once, but ETFs are always rebalancing. They issue and refund shares based on what investors want. Authorized users have to go source XRP when demand goes up. If a lot of money comes in on Tuesday, they will need XRP that Tuesday. It does not matter if there is not enough cash. There is no need to worry if availability is low. They need to get it. Now we have a case of scarcity meeting price effect. Traders say that ETFs don't change prices. That's true when the first batch of XRP is bought at launch, since producers usually stock up ahead of time or use over-the-counter OTC desks. But steady flows, those prices change. If OTC pools run out of money, which all signs point to them doing, ETFs will have to go straight to the markets. At that point, you feel pressure going up. That's when gaps show up. In the same way, many experts think the same thing will happen with ETFs once their flows mature. Let's look into the supply system in more detail. It's possible for analysts to see what's going on with exchange balances, OTC wallet clusters, and big holders because the XRP ledger is clear. One of the clearest patterns right now is the steady reduction of quantity that is available. That is not from individual buyers or hype cycles, but from structured, steady flows that look like action by institutions. Big blocks, clean times, not based on emotions, and most importantly, not chasing the market. There are signs that this is an ETF preparatory accumulation, even though we don't have official files from all the big firms yet. When you add in the fact that platforms are taking out 20 million XRP or more every day, you can see that the supply is getting smaller. And when supply shrinks without any explosive price movement, it means the buyers accumulating are disciplined. They are strategically gathering. They're adding up before the public story changes. Institutions always act this way in every market. Now we can talk about cash tiers. In general, there are 3 layers: Tier 1 exchanges, over-the-counter OTC desks, and big holders who sometimes take part in block trades. Tier 1 platforms have order books that can be seen. These include Coinbase, Binance, Kraken, Uphold, and Bitrue. OTC desks have bigger pools, but they're not endless. While big holders can step in, they usually do so carefully and don't want to dump into the market unless the price is right. When people who make ETFs need XRP, they usually start with over-the-counter, OTC, because it can handle big orders without moving markets. When OTC runs out, issuers have to use exchange liquidity, which is when the real risk comes in, because exchange order books aren't as deep as most people think they are. If you take out spoof orders and thin layer bids, there isn't much XRP available within an acceptable price range compared to how much institutions want it. This is the reason why the Shane Ellis idea comes up. Not because it's a sure thing, but because a big enough buy wall hitting a small enough book can make the price go up very quickly. Markets work like auctions. There is only one way for the system to handle too many buyers: raise the price until the market returns to balance. Let's talk about the bigger picture, which is something that people often forget. The world is getting closer to settling disputes in real time. Rails are being updated by central banks. The payment lanes are getting better. Tokenization frameworks, interoperability layers, ISO standards, and on-chain settlement choices are all being tested by Swift. In the same way that we send emails quickly and around the world with no problems, institutions are looking into how to settle value. Distributed ledger technology comes up in all of these conversations, and XRP is always mentioned in research papers, pilot projects, regulatory talks, and case studies that span borders. Not because someone is pushing it hard or because XRP fans are loud on social media, but because the ledger is designed for fast settlement at low cost, certain closure, and neutrality with other financial systems. In other words, XRP is made for the pipes. Most people get excited about price predictions. Plumbing is a big deal for institutions because pipes are what make numbers move. It's what keeps money markets, settlement of securities, business flows, money transfers, trade finance, and everything else going. That's when the XRP story stops being about a coin and starts being about a key piece of technology that is slowly integrating with old systems. That's the reason the ETF talk is so important. It's not just that the number went up. It's not just talk. It's proof that XRP is moving into the same investing areas that Bitcoin and Ethereum did before big companies fully adopted them. ETFs are one of the last ways for regular people to get hold of cash. Capital flows are linked to retirement plans, wealth management pipelines, advice networks, model portfolios, target date funds, insurance structures, and more, so once they open, they don't close again. But XRP is different in this way. In real life, supply is much more limited than most people think. Since Ripple can't sell into the US market, all institutional demand must come from the current circulating float. That is a big difference between XRP and assets like ETH or BTC, where miners or stakers are always adding new supply. When XRP's liquid float is pulled down, it doesn't rise again. It only moves things around. This is why market experts keep saying that the market will reach a point of no return. A time when limited supply and formal flows don't work well together. A time when the way prices work takes over. And that time is getting closer as over-the-counter pools run out. This is not advice about money. It gets easier to see as we learn more about this change in regulations. There was no chance in the chaos we've seen in the last few years. It was planned, timed, and managed in a way that was similar to a series of pressure tests meant to see which crypto projects could handle government scrutiny, institutional requirements, and global compliance standards. We are now in the next phase, and it's becoming hard to ignore how the utility assets are starting to separate from the hype assets. The reason is easy to understand. Utility can be measured, can be scaled up or down, and is needed for the new banking system. Because of this, these new rules aren't just rules, they're screens. Filters that keep trading and infrastructure separate. There are filters that separate market noise from demand from institutions. There are filters that separate the bull run tokens of yesterday from the liquidity engines of tomorrow. The reevaluation of cash as a national strategic resource is one of the most important changes going on right now. Banks, custodians, clearinghouses, and settlement lines that were slow, broken up, and expensive have been in charge of liquidity for many years. It was okay with governments because there was no other choice, but now there is. The old system is seriously threatened by a blockchain that has clear rules, stable throughput, institutional-grade compliance, and the ability to work with other blockchains around the world. That's why a lot of the legal talk we've been hearing lately is about stable coins, qualified custodians, settlement classification, and message standards that work across borders. The rails are being built around the tracks. This is the exact reason why projects like XRP have been put in a different category than the others. Not as investments, but as tools for quick cash that have a real purpose in the economy. And regulators have very different rules for things that are used for business purposes versus things that are only used for trading. What's most interesting is how many organizations have been getting ready for this change in secret. Banks never send out alerts about big changes in technology. They try quietly, work together quietly, and fit in quietly. After that, they flip the switch when the rules catch up. Some people believe that adoption happens when big, loud announcements are made. It doesn't. Adoption happens when infrastructure is improved and no one sees until the system changes overnight. In fact, we're going in that direction as real-time settlement networks, tokenized assets, and interoperability frameworks stop being experiments and become regulatory goals. You can tell they're not talking about random meme coins when they use words like mission-critical infrastructure, systemic risk, or settlement assurance. They are talking about the pipes that carry money. The global layer is another part that is often missed. The world is becoming more multipolar, and controlling your energy supply is just as important as controlling your liquidity trains. This is why every major economic bloc, the US, the UK, the EU, the Middle East, and Asia, is racing to update their settlement systems. And blockchain-based payment is a key part of all of these plans to bring things up to date. Some folks want CBDs, a few people want tokenized bank payments, some people want electric cars, but they all want fast clearing across borders without having to rely on old systems that cause problems and leave them open to attack. This is where neutral liquidity assets that follow the rules come in handy. No one wants to settle their transactions only with a single currency provided by the government. They want something that is free everywhere, can be transferred right away, can be programmed, and is liquid. At that point, the whole conversation changes to the assets that can support that amount of growth. You can see something important when you look at these changes as a whole. Crypto isn't moving slower because of rules. It's making a funnel. It is putting all of its money into networks that are compliant, scalable, and good for institutions. In this new model, the assets that do best won't be the ones with the loudest groups or the most powerful people. When trillions of dollars worth of liquidity finally move onto the blockchain, they'll be the ones who can handle millions of deals per second. And in that case, speculation is no longer what causes instability. It's because people want it. Demand from institutions, need for liquidity, market desire for infrastructure. That desire will keep going as long as it exists. There needs to be more liquidity as more firms join. The rails need assets that can bridge value quickly more when they need a lot of cash. Settlement networks depend on the base token to work more when there is more bridging. That's how usefulness changes into price change. First slowly, then all of a sudden. The funny thing is that most small buyers won't know what's going on until it's already happening. They're looking forward to news stories like government approves crypto or major bank announces XRP adoption. The real broadcast won't be visible to the public, though. It will be buried under a lot of regulatory language, settlement frameworks, liquidity mandates, and technology integration updates that sound dull, but will change the financial system in big ways. Banks and market systems don't change how they work to meet new compliance rules for no reason. They do it because they are getting ready for a big change that needs to be done perfectly. And assets that have a purpose are the only ones that can live in that setting. Things that are useful, things that have jobs to do inside the machine. This is where the present moment turns into history. The legislative fog is starting to lift after years of being thick, kind of not all at once, but enough to get a sense of what's to come, enough to understand why some networks were set up in a certain way, enough to figure out why the biggest institutions in the world have been trying the same asset over and over again without saying a word.